There's a clicker? Or?
Right here, and we found out this does have a pointer.
Cool. So Dick, here you go back and forth, clicker, forward, back.
Okay.
And
Speak into this.
Speak into this for the webcast. You ready to rock?
I'm ready to rock.
I'm gonna leave it.
Oh, yeah.
All right. Okay, everybody, I'd like to introduce our next presentation here at the Planet MicroCap Showcase Vegas in partnership with MicroCap Club. Up next is Dave Cole from EMX Royalty.
Thank you, Robert. Our pleasure to be here. We haven't been at this show for a long time, and I must admit that most shows that I go to are more mining focused than this one. So I will take an opportunity to discuss some of the basic aspects of our business model and what's going on in the mining sector today. Obviously, commodity prices have been skyrocketing, so there's some interesting things that are happening. I will point out that Kit Springs does investor relations work for us. He has some presentations he's happy to hand out to you in hard copy in case you'd like to have those. And, you know, the fundamental idea behind our company is that the value of mineral rights over time augments. And a great example of that is when I was 10 years old, the price of gold was $32 per troy ounce. Today it's $3,200 per troy ounce, which is a CAGR of about 9% over half a century. And it's not dissimilar for copper and other metals across the natural resource space. And it just exemplifies the fact that as John Paul Getty said, the meek shall inherit the earth, but not the mineral rights. Tongue in cheek, of course. But you know, we fundamentally believe that the value of mineral rights goes up over time, and the best way to be exposed to mineral rights is royalty ownership. Royalties typically are contracts that the counterparty, the operator of the mine, has to pay us off the gross revenue to the mine. And there's different types of royalties on different commodities, but that's the general premise. For example, if a person writes a book and sells it to a publisher and they keep a royalty, they get $1 for every book that's sold. We get a royalty on a copper mine. Every pound of copper sold, we get a cut off the top. And so because it's off the top, it is less exposed to cost overruns, et cetera. So there's a magical thing about royalties called optionality, and that is that we are exposed to commodity price optionality, the likelihood of the commodity over the long haul to go up or down, as well as, very importantly, discovery optionality. And as the counterparties invest their money, not our money, into the ground to make more discoveries, to make engineering advances, to make metallurgical advances on the asset, et cetera, those all are to our benefit, and they're multiplicative. So the price of gold goes up, the geologist finds more gold, the engineers figure out how to get more of the gold out of the ground. The value of our royalty keeps going up at no cost to us. And this is a beautiful thing that makes the royalty business model particularly interesting, and why we've focused on building a royalty portfolio over the course of the last 22 years. We touch nearly 5 million acres of mineral rights worldwide, have over 140 royalties. 6 of those are production cash flow, where the mine's actually in production, paying us production cash flow, and another 40 have pre-production payments. Many of the deals that we write have pre-production payments in those. We touch nearly 12,000 mining claims in the western U.S., and Leeville is the largest producer for us in the U.S. today. It's a gold mine here in Nevada, northern Nevada, operated by Barrick and Newmont in the joint venture Nevada Gold Mines. This asset's currently paying about $5.5 million a year, and maybe a bit more at today's gold price. Another small producer for us is Gold Bar South. But within this whole portfolio, there's a whole host of money being invested in our assets by the counterparties drilling off new discoveries, including, very importantly, the copper discoveries in Arizona, at Arizona Sonora, and the Park Salyer deposit as one example. And it's this ability for our counterparties to invest tens of millions of dollars, drilling hundreds of kilometers of core holes a year across our portfolio that creates that discovery optionality. Going to South America, most significant asset is our royalty on the Caserones mine. This is operated by Lundin Mining Corporation. It's a huge copper and molybdenum deposit that has a mine life that, when we first got this royalty, was 18 years, then it went to 28 years, and Lundin has been investing substantial money to find high-grade copper and molybdenum mineralization in pit, just immediately beneath what they already knew was there, and that's a great place from our perspective as a royalty holder. And I'll show you some additional slides that talks about our royalty footprint there and how Lundin's investing in that is all to our advantage. That royalty is currently paying about $10 million, pardon me, per annum. And that's all in USD. We are a Canadian company, but we account and report, and all the numbers I'm giving you are in USD. Moving to Fennoscandia, Scandinavia plus Finland, where we're one of the largest mineral rights holders in that part of the world. There's a key asset there called Viscaria, which is a copper gold deposit in northern Sweden in the Kiruna district, the largest underground iron mining district in the world. And we're in the copper portion of that district. That's a royalty that will come on within a year or two. Our most valuable royalty within the portfolio is in Serbia. We've gotten extraordinarily lucky here, which is another way to say that optionality has worked in our favor. And we're exposed to multiple royalties within the Timok district that are all operated by Zijin, the sixth largest mining company in the world, the fourth largest copper producer in the world, and they've had phenomenal success at finding new copper gold deposits within our royalty footprint in Serbia. This one's currently paying about $5 million a year while they're mining in the upper zones. But when they get into the lower zone there and other zones that they recently announced, this royalty will increase in payment substantially by many-fold, actually. Another key asset within the portfolio is Balya in Turkey. That's lead, zinc, silver. It's paying about $2 million a year right now. In fact, our last payment this quarter was a record. And Gediktepe is an oxide gold silver deposit that's paying handsomely. It's paying over $1 million a month right now. But that oxide zone has a short mine life, so I'm only expecting to have income from that for about another year. They might find a little more. Then they move to the deposit that's beneath the oxide. That's a copper zinc deposit. And so there'll be a small hiatus, and then we'll go on from there. So Sorda is a nice little payer for us. But just to give you an example, and so we've been building this portfolio for 22 years, and we've reached the point where we've crossed the tipping point, and we are significantly cash flow positive. So we've been cash flow positive for 3 years now, after having invested in this portfolio for 2 decades, and the money's coming in the door. Here you can see our adjusted royalty revenue, which would come from a variety of metals, but most dominantly gold and copper. I will point out that gold is about 50% of our current revenues on a backward-looking basis, maybe a little bit higher at today's gold price. But looking at in-ground net asset value, we would be dominated more by copper because the copper assets that we are exposed to have very long mine lives. They're huge. They're generational deposits. So really, the long-term value is weighted more towards copper. Right now, we're doing very well with our gold. And you can see our adjusted EBITDA. And as I pointed out, we've been significantly cash flow positive for the last 3 years. And we'll talk about what we're doing with that money from a capital allocation strategy standpoint real quick. Right now, we're trading below our PNAV ratio of 1. We're trading at about a PNAV based upon the analysts of 0.4, which is astonishingly inexpensive. Taking advantage of that, we've been buying back our stock. We've already bought back 5% of the stock. And while I'm on that note, I'll make the point that we trade on the New York Stock Exchange, ticker symbol EMX as our name, and on the Toronto Stock Exchange, ticker symbol EMX. Most of our shares trade on the New York, about 85% of the volume, 15% volume in Toronto. In addition to buying back our stock on the capital allocation side, we've also been paying down debt. I borrowed $52 million to get into a couple of these key assets to give breadth to the business, gain scale, and we've paid that down from 52. Now we're down to $25 million. That debt is held by Franco-Nevada, the largest royalty company in the mining space in the world. They're close friends of ours and have followed the company closely. I used to work with them when I worked at Newmont Mining Corporation before leaving to found this company 22 years ago. And they are a shareholder. Franco-Nevada is a shareholder in EMX. We're the only junior royalty company that they own stock in. They're our debt holder, and we also have a joint venture with them looking for new royalty purchase opportunities. So this is where the money's coming from right now with respect to the royalty revenues coming from Gediktepe, Timok, Leeville, Caserones, and others, as I mentioned. This is the breakdown on a backward-looking basis of copper, gold, but significant income coming in from lead, zinc, silver, and molybdenum as well. And last year, we smoked our guidance. So came in at either above our guidance or on the very high end. both on a what we call GEO, gold equivalent ounce basis. It's traditional in our sector that we report in gold equivalent ounces, which is just accounting in gold ounces. We usually give guidance in GEOs as well as in USD. And you could see that we came in the very high end of our guidance range on a GEO basis. We beat our revenues last year substantially, thanks largely to the fact that the price of gold and copper both did very, very well. Then we also collect money from pre-production payments coming into the company as well, and that's always been a key aspect of our business model. Point out again that we've bought back 5 million shares of our stock over the course of last year. It's a little more than that now, going on 5.5 million shares. We're still buying nearly every day in the market. That's all publicly released, and we report those purchases at the end of each month. So a good way to illustrate this concept of multiplicative optionality, building value for us, are these assets. These are the key assets within the company that drive our net asset value, our in-ground NAV. And Timok's the most phenomenal example. I bought the Timok royalty for 200,000 Canadian dollars. It's already paid 14 million USD, and the analysts say that what's in ground is worth 166 million at a 7% discount rate. That's before Zijin, the operator, announced that they made a huge new copper gold discovery within our royalty footprint just last month in their annual report. We had a chance to tour that property in the field. I was in Serbia just a few weeks ago, and we're extraordinarily excited. There's 12 drill rigs turning on that. But this is an example of what I'm talking about. We've got that royalty. We don't have to pay for the exploration work. They do. They keep finding more copper and gold. We win. And so an asset that I paid 200 grand for has paid 14 and is worth 166 in the ground, plus more for the new discovery. Leeville, I paid a little more for. I bought that many years ago when our securities were very well valued and it was a stock transaction. It's already paid back everything that we invested to buy that asset, and what's in ground is worth that all over again. And as I said, this is an asset's paying about $5 million a year right now. Caserones, I paid 65 million for. It's already paid 30. That was just a few years ago I got this, and the analysts say it's worth 105 million more from what's in ground, and that's before Lundin Mining Corporation announces the year-end results from their exploration program, which we have every reason to believe has been highly successful. So, just to give you a few examples. So the two kingpin assets within our portfolio around the world are these two long-lived copper assets, copper and molybdenum, where we have a 0.8306% royalty in Chile, and copper gold in Serbia. Both of these are fractions of century mine lives and growing, and have substantial footprints. These are the big NAV contributors. And then in addition to that, Gediktepe, which I discussed a minute ago, we have the 10% royalty in oxide. Keep in mind that's a short mine life. The sulfide comes after that with a 2% royalty. That'll switch from a gold-silver stream to a copper-zinc, gold and silver after they move into the sulfide. The sulfide deposit there will be 10 years or more in mine life. Leeville's been producing for a very, very, very long time, and it looks like it won't stop in my lifetime. And we're very pleased to have that. I was involved in the discovery of the Leeville deposit when I worked for Newmont Mining Corporation. So it's great to be in the position today where we get checks every month as a result of the discovery that we made with Newmont back then. And Bali is an example of us generating royalties. We acquire royalties in two ways. One, we go out and buy royalties that somebody else created. Two, and this is our hedgehog, we acquire prospective mineral rights through staking and mining claims, or acquisition of exploration licenses in Sweden, for example. We coalesce the geological data. We then collect additional data in the field. We illustrate the prospectiveness and sell that onto the industry in exchange for various commercial terms, cash payments, share payments, annualized payments, pre-production, in addition to always a royalty at the end of the day. And those two mechanisms together are very powerful because we're generating royalties organically whilst we're waiting to find a royalty to buy that we think is distinctly accretive to help build our portfolio and gain mass and put us in the situation that we're in today. Forthcoming production will come from the Chapi. This is a copper royalty we just recently bought in Peru. $10 million investment, should have a fairly quick payback. This is a mine restart, and we're happy to help that company get that mine back into production. The key reason why we did this is because we believe that the long-term exploration potential on this asset is huge. What we can see today, which drove the cost of $10 million, is a fairly small deposit, but we think long-term there could be big things to be found at depth. And that speaks to our alpha, which really drives our value creation here, and that's our economic geologic intelligence. Because it's the discovery of new assets within your royalty footprint that truly drives the value creation here, and that comes back to geological interpretation. And that's our alpha. And my background's economic geology. I was on the prospecting side of Newmont Mining Corporation for 18 years before leaving to start this company 22 years ago. And our team is a bunch of crackerjack geologists and engineers. We're quite strong on the technical side. Viscaria, copper, and gold and iron deposit in Sweden comes into production next year. They're well funded. They just got their last permit, actually, from the Swedish government, and very pleased to see that coming into production. Park Sailor is a new discovery in Arizona. It's an excellent example of discovery optionality coming to fruition. This is an asset that we acquired practically for nothing. Very inexpensive entry point because we acquired the mineral rights cheaply, sold it off, they made a discovery, we win. So speaking of winning from discovery, this is the royalty footprint at the Caserones mine operated by Lundin Mining Corporation. Lundin, one of the most successful mining companies in the world today, just recently bought 75% of this asset from JX Nippon, who was the previous operator, and still has the smelter offtake agreements. So when Lundin came in, they increased exploration expenditures substantially. Last year they spent $14 million. This year they're talking about spending $22 million. They increased the number of drill meters to 18 kilometers just on this asset. Once again, I'll say it again, at no cost to us. So we have this royalty over that entire yellow footprint. That footprint is roughly the size of Phoenix, just to give you a sense of scale. And the producing mine there at Caserones in the middle is doing exceedingly well, and the new discoveries that they're making, most importantly, are at depth in that deposit. That's the best place to find more mineralization, is at depth, and they're higher grade. The cousin of the Lundin family is on our board of directors, and he tells us that his family members are very excited about what's going on here. They're also making a new discovery called Angelica, immediately adjacent to the Caserones operations. There'll be immense synergies in regards to infrastructure, and Angelica, it will be another great deposit that we'll have this royalty on. As I said, this is paying about $10 million a year right now. The most valuable royalty in the portfolio is in Serbia. And we generated royalties here through our royalty generation. You can see that we have a myriad of different licenses at different stages in the district with different royalty rates. The huge deposit that was found here, it's the largest copper and gold deposit found in the history of Europe and put into production, and one of the largest copper gold deposits that's been recently brought in production in the world. It's called Timok. It's on the Čukaru Peki license within eastern Serbia. And this was our first business unit when I started the company, in fact. They're currently producing from the turquoise-colored upper zones right now and paying us about $5 million a year in current royalty revenues. But that big lower zone is the huge, what we call porphyry copper system, copper and gold, and it's absolutely immense. That's in addition to a whole new discovery that has been made here called the MG zone. And all of this has accumulated up to a situation where our in situ value of this small royalty, 0.3625%, so about a third of 1%. The in situ metal value at today's metal price is getting close to 900 million USD. And that's all metal that will come to us based upon the current resources and reserves that will come to us at no cost to us. That's the way you want to think about that. So when you put that into your model, you need to think about what discount, because of course the number I gave you is non-discounted. You want to think about what discount rate you want to use, but then you have to decide what copper and gold price you want to use. And then you need to figure in what's the potential for more to be found. And the answer is extraordinarily likely. There's 12 drill rigs here turning, advancing the new discovery at the MG zone. This is a phenomenal, this is the most important example within the portfolio of how we went through this aspect of royalty optionality. So if we see the the deposit in cross-sectional view. This is from the Zijin website. You can see the huge lower zone. They're advancing multiple shafts and declines to get this into production. The lower zone should be in production within 2 to 3 years. We just toured there recently. We went underground. The 2 upper zones are already in production. And this lower zone is open-ended completely at depth. And they showed us some recent drilling where they hit some of the highest grade mineralization they've ever found at depth here. And they've invested over $5 billion to advance this asset to production. And Zijin has a great relationship with the Serbian government. And always very nice host for us when we come to tour. We have the right to tour once a year. Everyone's very excited about this MG zone. This is 7 kilometers to the southeast of the Timok operation within our royalty footprint. There's 12 drill rigs. We've been to the field, verified this. We've been following the location of these drill rigs and drill pads as that pattern has moved to the south and to the north, excuse me. As they've advanced this, and we're very, very excited about what's happening here. The initial resource was announced in the Zijin annual report, 150 million tons at 1.8 to 7% copper and 0.61 grams per ton gold. That's 2.81 million tons of contained copper and 3 million ounces of gold, just to do the math for you. And this is a truly phenomenal asset that's extraordinarily high grade, one of the highest grade copper gold discoveries ongoing in the world today. With 12 drill rigs continuing to turn, it's only going to get bigger. So, the investors in this company include Franco-Nevada, the world's largest royalty company, Extract Capital, Darren Millmeister, recently has been increasing his position in the company. He's over 9% now. Sprott has been with us from the very beginning. Paul Stephen, who's an aficionado, he's a generalist actually, but he loves the royalty business model. He was an early investor in Franco-Nevada. And collectively between himself and his children, et cetera, these are around 10%. Yeah. So, and then the operators, these are the guys that employ their CapEx and their expertise into our assets to create this wonderful thing called optionality. It would include Zijin, Lundin Mining Corporation, Nevada Gold Mines, that's Barrick, et cetera. We've worked with a whole myriad of mining companies, including the largest mining companies in the world, such as Rio Tinto, BHP, Newmont Mining Corporation, which is my alma mater, it's a nice opportunity to be able to work with them and get their expertise employed on our properties as well as their money. So our share count is down to 108 million as we have bought back 5, and we're buying back shares every day. We're buying shares today, in fact, with 122 fully diluted. Sitting in a cash situation at the end of last quarter, 26 million USD in the bank, and debt of now 25 million. As we just recently paid down 10 million more in debt, that was publicly announced here a couple weeks ago. And that was from a key pre-production payment that was made to us from an asset discovery that's ongoing in South America called Diablios, operated by Abra Silver. If you're interested in a up-and-coming gold-silver discovery, that's a stock to look at, and we're very pleased to have a 1% royalty on that one. As I mentioned, the expertise within the company is dominantly engineering and geology. We've recently added Stefan Wenger as our CFO, a fantastic addition for us. Stefan was with Royal Gold, the second or third largest royalty company in the world. He was with them when they went from a $200 million market cap to $3 billion. A great, nice phase, and then he went into retirement. I talked him into coming out of retirement and coming out as our CFO because he said he wants to do it again. So over the long haul, our stock's been quite volatile, but has had a nice 14% compounded annual growth rate. And I think that right now is an excellent time to buy this stock, and I'll point out that we're trading at less than half of what analysts say our in-ground net asset value is. And I'm happy to take questions. Yes, sir. So the question is, how does the industry balance cost of capital versus opportunity, and how does that affect our business? So we're in the luxurious position where it's not our problem because we just have the royalty on it. That's for them to figure out, but it certainly does impact their ability to advance that asset. If you look at Zijin, they've always had magical ability to raise all the money they need. And that's why they've been one of the fastest growing copper companies in the world. They have very, very strong support at home in China, as one example. Newmont Mining Corporation, very strong cash flow. Barrick, strong cash flow. Lundin Mining Corporation also has a low cost of capital and is very well regarded. So it's nice to be in a situation where the counterparties that we have on the big company side are doing very, very well, right? On the small company side, this has absolutely impacted our business because the small companies, even despite high metal prices, the small companies had a difficult time raising capital. So that slows down their exploration on our assets. It's just a fact of life. We have a lot of teeth written into our deals, so if they don't do enough work or make their payments, we get the projects back. And that's happened many, many, many times. So we recoalesce the data, illustrate the prospectiveness, and sell it again. We've done that multiple times in our career. So we know how to manage that risk, and we help mitigate that risk through teeth within the deal. Does that answer your question? Yeah. Yes, sir. Yes. So the ratio of success in this industry is wickedly low. And this is why we want to be exposed to millions of acres of mineral rights. Because occasionally, and of course, I like to talk about the big wins. So that our objective is to keep our costs very, very low so we can generate a royalty for a couple $100,000 and it might be worth $1 billion. But the ratios, you hear some people talk about the ratios in the industry for a major new mine, 1 in 1,000. We're happy if a small mine gets built, so I think our ratios are much better than that, sort of 1 in 100. And the key to this model is asymmetric risk profiles, where we're exposing ourselves to upsides where if the win, it's huge. If the loss, we lose a few $100,000. Something, let's say Chappie's a $10 million purchase and something goes wrong there, then potentially we could be out 10. But that's a more advanced asset that we did extraordinarily tight due diligence on from an engineering perspective. We're very confident that we'll reach payback from the production of that small deposit that we know is there, past producer, so we feel pretty comfortable with that. But the asymmetrical aspect of the risk exposure is the potential to find a big one at depth. And that's the way we think about that in our analysis. Appreciate you guys all coming out. And any more questions? Yes, sir. Yes, those warrants are currently out of the money, and they are held by Franco-Nevada. Franco-Nevada owns 6% on a fully diluted basis, so that would include those warrants. We're delighted to have Franco as a security holder. It's a very synergistic relationship between us and them. They hold our debt as well. And the strike price on those warrants, I believe, is 4.45 Canadian. We're trading around $3 Canadian. I think it's entirely likely that those will get exercised, however. And when Franco bought in, which is the last financing that we did, the green dot here, at $3.30 CAD, they bought in at a 25% premium to the current price, which covered the value of that warrant. And we're delighted to have that money. Those monies were put to use buying additional Caserones royalty, which has enhanced our cash flow and added scale to the business. One thing I point out on the slide is that the green dots where we've raised money have all been during times when we had a strong share price. We've never done big down market financings ever in the history of the company. You see the blue diamonds on the right. This is when we initiated the buybacks. Yes, sir. Share price appreciation. We will institute a dividend after we reach a reasonable PNAV. Right now, our PNAV is below 0.5. It's ridiculous. Best thing I can do is buy back my stock. So that's one of the key things we're doing. We're buying back all the stock that the exchange will allow us to buy back, which is about 5% a year. And I can't buy a Caserones or a TMUC royalty at half NAV because it's no secret that royalties are phenomenal financial instruments. So you go into the secondary market to buy TMUC. It's going to cost you 1 to 1.5 NAV with a 5% discount rate, I'll add. But I can buy my stock back. And so many of my shareholders think it's absolutely the best thing to do. After we reach, and we'll reach a point where we'll get back to above 1, then we'll seriously consider putting on a dividend, and we'll increase that dividend annually thereafter. Thanks a lot, everybody.
Anyone wants a presentation